Hi everyone, welcome. In this session, we are going to examine the monetary policy transmission mechanism. The main objective is to list and summarize the transmission mechanism through which monetary policy can affect the real economy. The transmission mechanism examines whether one variable affects another by using data to build a model that explains the channel through which the variable affects the other. So, here the overall transmission mechanism is look like the change in the money supply affects interest rates affect investment spending. This is what we know overall. This is our general understanding or the about the conventional monetary transmission mechanism. So, in this session we are going more in detail what are the conventional, that we will discuss little bit more detail. Then we will also discuss what are the other mechanisms of monetary policy transmission. So, before going further, let me define what is monetary policy transmission. So, monetary policy transmission is the process through which changes in monetary policy affect economic activity, including aggregate demand, GDP, employment, etc. So, about the monetary policy, by now you are familiar what are the tools central bank use to affect to conduct the monetary policy, what are the tools they use, and of this we have seen that most central bank they use short term interest rate, Fed fund rate in the US, for example, repo rate in India. These are the short term interest rate, these are the policy instrument in the conduct of monetary policy. Then what we are going to look at, the monetary policy transmission is thus the process through which a change in the policy rate, for example Fed fund rate and repo rate, is transmitted first to the short term money market rate and then to the entire maturity spectrum of interest rate, including long term, covering the money and bond market, both money market as well as the capital market, as well as banks, deposit and lending rates. So, these are the initial stages of the transmission, and subsequently we are trying to link this to the other important economic variables. So, this in turn impact investment decisions, consumptions, which would affect aggregate demand and output inflation. So, there are several the way in which monetary policy affects the economy. These are actually mainly through the aggregate demand and the economy. There are different economists have identified various channels through which the monetary policy affects aggregate demand and the economy. So, the first one is the traditional interest rate effects, that is one. Then the second one is other asset price effects, and finally thirdly the credit view channel. So, let us discuss one by one. Coming to the first one, I think you are familiar with this one. This is called the traditional interest rate mechanism. So, in the case of the traditional interest rate mechanism, the traditional view of the monetary policy transmission mechanism is that a change in the money supply affects interest rate. Suppose we can look it in any way. Suppose if the monetary policy strategy is, for example, money supply targeting, that is the monetary aggregates targeting, that is one. So, anyway, if the central bank targets the money supply, and then this would lead to changes in rate of interest, right. If the money supply is increased, then you know that rate of interest is decreasing, will decrease. That is one starting point. The other one is changes in short term interest rate, that you are well familiar now, FFR and repo rate. That means directly the starting point itself is changes in rate of interest. Suppose decline in the reduction or cut in the rate of interest, and how then you know that this would be affecting the short term interest rate will be affecting the long term interest rate. This also will get affected, because the theories that we covered in the previous sessions clearly show that there is high correlation between short term interest and long term interest, right. So, So, an important feature of the interest rate transmission mechanism is its emphasis on the real interest rate rather than on the nominal interest rates as the rate that affects consumer and business decisions. So, let us put it the more schematic way, schematically let us put how does it affect. So, in moreover as we have seen here is that it is often the real long term interest rate that is viewed as having major impact on spending. So, here more schematically what we can do that we can explain this process. One is interest rate affects investment spending, and you know that investment spending is a component of aggregate spending, because in the macroeconomic framework the aggregate spending, the aggregate demand is equal to consumption aggregate demand investment plus government expenditure in a closed economy. So, here a decline in rate of interest would lead to an increase in investment spending. Let us see, these are the schematic presentation show that an easing monetary policy, that means an expansionary monetary policy, leads to a fall in interest rate, this one a fall in real interest rate causing a rise in investment spending, then this will lead to an increase in investment spending. You know the reason, because decline in rate of interest means the cost of borrowing for the firms decrease, the cost of production decrease. So, that means they will increase their investments in capital goods, and that capital goods, and then that means they will set up new factory, buy new machines, and then they will be hiring more laborers, and that means they are organizing, they are expanding the production process. That means as a result you know that aggregate demand will increase, because it is also the demand for the aggregate demand, this will increase, aggregate demand will increase, and this would lead to more production and more employment in the economy. So, the same way, the way that we discussed this increase in investment, this is the investment, just now what we discussed was the investment made by firms. So, the same way the investment made by consumers, that is to buy houses and consumer durable expenditure, is also can be considered as one kind of investment decision. Not only firms, if the rate of interest decline, and then you can see that the demand for housing and consumer durables, that also increase. So, both actually contribute to increase in aggregate demand. Aggregate demand increases as a result, you can see aggregate demand is increasing. So, the GDP will increase as a result, and the subsequently employment also increases. So, this is one of the channel. This is the conventional or the traditional interest rate mechanism which leads to increase in, that means easing of monetary policy or an expansionary monetary policy leads to increase in GDP through this. However, some economists, they, for example Ben Bernanke, former chair of the Fed, and Mark Jettler of New York University, they believe that the empirical evidence does not support the strong interest rate effects that operate through the real cost of borrowing. So, as a result, indeed these researchers see the empirical failure of traditional interest rate monetary transmission mechanisms as having provided the stimulus for the search for other transmission mechanism of monetary policy. Accordingly, these other transmission mechanisms, they are in search for other transmission mechanisms that leads to fall into two basic categories. One is those operating through the price effects, other price effects, and the other one that we are going to discuss shortly, that is the credit view. The third channel is the credit view. So, about the asset price channel transmission, explain when the monetary policy transmission happen through the asset price channel, when changes in monetary policy influence the price of assets, such as equity, real estate, that lead to changes in consumption and investments. So, a change in price of assets can lead to a change in consumption spending due to associated wealth effect. For example, if interest rates fall, people may consider purchasing assets that are non-interest bearing, such as real estate and equity. Further, a rise in demand for these assets may result in higher prices, a positive wealth effect, and thus higher consumption. Further, if equity price rise, firm may increase investment spending. So, let us examine the asset price effect one by one, each issue wise. The first channel, one of the channel that affects the monetary policy through the asset price effects is the exchange rate effects on net exports. So, especially with the growing internationalization of economies throughout the world and the advent of flexible exchange rate, more attention has been paid to how monetary policy affects exchange rates, which in turn affect net exports and aggregate demands. So, this channel, that the monetary policy transmission through asset price effects occurs when changes in monetary policy impact the interest rate differential between domestic and foreign rates, leading to capital flows, that is inflow and outflow, which in turn affects the exchange rate and hence the relative demand for exports and imports. For example, the foreign exchange rate channel, it also involves the interest rate effects, because when the domestic real interest rate fall, that means as a result of, for example, an expansionary monetary policy, when the domestic real interest rate fall, the domestic currency assets become less attractive relative to assets denominated in foreign currencies. You know, there will be a capital outflow because when the domestic real interest rate fall. So, as a result, you know, when there is a increase in capital outflow as well as decrease in capital inflow. So, as a result, the value, because there is more demand for foreign currency, thus the value of domestic assets, that means the value of domestic currency assets relative to the foreign currency assets fall, and the domestic depreciation, domestic currency depreciation happens. For example, if the interest rate, real interest rate in India declines as a result fall because of expansionary monetary policy, as a result there will be capital outflow as well as decline in capital inflow, because now it is worth for the investors to invest in other country instead of in India, because the rate of interest is low. There will be capital outflow, then as a result the demand for Indian currency declines and there will be depreciation of Indian currency. So, when the depreciation happens, that means the lower value of domestic currency makes domestic goods cheaper than foreign goods. You know, then our goods and services become cheaper, then that means thereby causing a rise in net exports. That means the demand for our exports increase as compared to the imports. So, as a result the net exports increase, hence aggregate demand increase. So, the schematic presentation of this one is that a decline in the real rate of interest would lead to depreciation in the exchange rate. That means as a result demand for our goods, that means our exports increases and import decreases. That means net exports increases. Net exports increases means there is increase in demand for the aggregate demand. That means the in net exports increase means there is net increase in the aggregate demand. When the aggregate demand increases, then the GDP increases, and as a result the employment also increases. So, overall GDP increases means the level of economic activity increases. This is the channel related to the exchange rate effects. Another effects is through the Tobin's Q theory. James Tobin developed this theory, which is widely known as Tobin's Q theory. The Tobin's Q theory explains how monetary policy can affect the economy through its effects on valuation of equities. So, before going further, let me explain what is Tobin's Q theory. The Tobin defines Q as the market value of firms divided by the replacement cost of capital. That means Tobin's Q theory. So, we can write Q is equal to what is the market value of a firm. market value of a firm divided by the replacement cost of a capital. Replacement cost of capital means the actual cost in order to buy the machines, the equipments, and that means the factory and all the machines and equipments. In order to buy, how much is actually required, what is the actual cost. We can also call it as the replacement cost. That means if you want to replace all the machines and factories, then how much it costs. For example, let us assume that this is 100 billion, right. Let's just assume that this is the replacement cost. It also see that this is the value for buying the machines and equipment if you want to replace. But you know that due to the this market, the stock price of this firm, the equity market value that because of the good prospects of this company, the profit is earning, and because of that, suppose that though the actual cost of the assets of this firm is only 100 billion, that is the replacement cost. Suppose because of the prospects this company is having, the dividend is earning because of the strong economic fundamentals, and the market is valuing this company is worth as 200 billion. So that means the Tobin Q ratio, accordingly you know that this one is 2, that is greater than 1. So what does it mean? So it means if the Q is high, the market price of firms is high relative to the replacement cost of capital, and new plant and equipment capital is cheap relative to the market value of firms. So it means the companies can issue stock and get high price for it relative to the cost of facilities and equipment they are buying. So that means since the market is valuing them more than their actual cost, actual investment cost, this firm they can increase the investment spending will rise, because firms can buy a lot of new investment goods with only a small issue of stock. That means you can see that if they increase, suppose if they increase this one to 100, suppose if they make it to 150 billion, if they spend, and then actually when they issue the stock, actually the additional that you can see that let us make it delta 50 billion they are additionally issuing, that is the actual purchasing cost of the machine, but the market is going to give them 100 billion, right. So that means they can raise more capital. So this will increase, incentivize the firm to raise more capital through IPO. So conversely, we can also see that if the Q is low, that means the firms will not purchase new investment goods, because the market value of firms is low relative to the cost of capital. Suppose if when the Q is less than 1, that means the market valuation of the actual cost is less than the replacement cost of this capital. So let us come to the crux of this discussion. What is the main point here? Suppose there is an easing of monetary policy. Suppose as a result, suppose there is an expansionary monetary policy, that is easing monetary policy, then you can see that the rate of interest declines. That means low interest rates on bonds means that the expected return on this alternative asset, that is on this alternative to stock falls, right. When the rate of interest decline, we have seen discussed in the previous sessions that when the rate of interest decline, that means lower real interest on bonds, it means that the expected return on this alternative to stock falls. So as a result, the stock price will increase. So when the stock price will increase, that means Tobin Q ratio will increase. So that means when this firm, not only for this firm, most firms, what happened that the Tobin Q ratio will increase. So now this one will become, for example, 300. Suppose Tobin Q stock price increase, that the market valuation of the equity increase, then the Tobin Q ratio is going to be 3. Then obviously apparently is clear to you, that means the firms will increase their investment activities, that means the investment will increase, that means aggregate demand will increase, that means the GDP also increase, that means overall economic activity will increase, the level of economic activity will increase. So this is through the Tobin Q ratio. This is the schematic presentation, pathway of how expansionary monetary policy policy would lead to increase in economic activity through the Tobin Q ratio. Then comes the wealth effects. In the wealth effects, an important component of consumers' lifetime resources is their financial wealth, a major component of which is common stocks. So, here when stock price rise, the value of financial wealth increases, thereby increasing the lifetime resources of consumers, and consumption should rise. So, as a result, you know that the consumption, the present consumption also depends on the lifetime resources available for the consumers. So, when the rate of interest decline, then you know that again the schematically the stock price increases, and you know that consumers hold a large share of the common stocks. So, as a result, when the rate of interest decline, when the stock price increase, you can see that the consumers wealth increases. That means their lifetime resources available with them increases, and the consumption increases. When consumption means, because we have seen that aggregate demand is equal to C plus I plus government expenditure. So, that means here consumption increases means aggregate demand also increases. So, let us present this one. What are the channels that we discussed? This is the diagrammatic presentation of this one, the entire transmission mechanism. This one we have already discussed. Exchange rate also we have discussed. Tobin Q ratio we have discussed. Wealth effects just now we have covered. Here means monetary policy, it affects the stock prices, and that means stock price increase, financial wealth increase, then as a result consumption also increases. So, let us use this framework to explain the remaining aspects, the remaining monetary transmission mechanism that is under discussion. Here another channel is called credit view. Credit view means the transmission through the credit channel happens if monetary policy influences the quantity available for credit. So, this may happen if the willingness of financial institutions to lend changes due to change in monetary policy. There are, based on the analysis that demonstrate that banks play a special role in the financial system because they are especially well suited to solve asymmetric information problems in the credit markets. So, we have discussed this issue in details, how banks are well trained, expertise, they have expertise in addressing the asymmetric information problem. So, let us see which are the through the monetary credit view channel where the monetary policy can affect the aggregate demand. So, the first one is bank lending channel. So, here an expansionary monetary policy, it increases the bank reserves. You know that actually when an expansionary monetary policy, be it open market operation or lending that a discount window, the bank reserves will be increasing. So, bank reserves increase means as a result bank deposits also increases, and it increases bank reserves and bank deposits, and it will lead to raises the quantity of bank loans available. So, because many borrowers are dependent on bank loans to finance their activities, and increase in loans causes investment spending to rise. So, not only consumers but also it will have greater impact on expenditure by smaller firms, because the smaller firms which are more dependent on bank loans than the large firms, because we have seen in our previous sessions that large firms, they can raise their capital through the market, through the bond market. They can easily borrow from the bond market, and they can easily raise through IPOs as compared to small firms, mainly because of the asymmetric information issue. So, you can see that if expansionary monetary policy through this channel, not only consumers benefit bank loans, but also the firms also benefit. So, as a result you can see that investment expenditure will increase and aggregate demand also increase. Then the another channel is the balance sheet channel. Balance sheet channel here means the balance sheet channel of the firms is arises because in the presence of financial friction in the credit markets. So, the debt obligations of businesses may also change due to change in the interest rate. For instance, if the policy rate falls, debt obligation of firms may decrease, strengthening their balance sheets. So that means low rate of interest, that means as a result the financial institution may be more willing to lend to businesses and thus increasing investment spending. The important thing here is that as a result of the balance sheet channel, when the rate of interest declines, we can see that the stock price is increasing, firms net worth is also increasing. Then when you know that actually, and why higher the net worth means lenders in effect have more collateral for their loans, so their potential losses from adverse selection will be lower. And similarly, that means there will be less adverse selection and there will be less moral hazard because the net worth of the firms increases. So that means this would incentivize the financial firms, financial institution to lend, and as a result investment increases and aggregate demand also increases. Then the other channels is cash flow channels. The cash flow means the difference between firms' cash receipts and cash expenditure. So because here an expansionary monetary policy, when the rate of interest decreases, firms' cash flow increases. You know why? Because the rate of interest decrease means the only the nominal rate of interest is decreasing here. The rate of interest is when the rate of interest decrease, you can see that the real the payment, the debt burden of the firms decreases. That means improvement in firms balance sheet because it raises cash flow. So an increase in the cash flow increases the liquidity of the firm, that makes it easier for lenders to know whether the firm will be able to pay its bills. So here importantly you can say that when the cash flow increases, the scope for adverse selection and moral hazard decrease, lending increase, investment increase, aggregate demand also increases. So this we have discussed this one. Now bank lending channel we covered, balance sheet channel we covered, cash flow channel we covered. Then the remaining two are unanticipated increase in price level, and another is household liquidity effects. And coming to unanticipated price level effects, the mechanism is through here, because in industrialized countries debt payments are contractually fixed in nominal terms, and unanticipated rise in price level lowers the value of firms' liabilities in real terms. That means this would reduce the burden of the debt. So you know that when the decline in rate of interest due to monetary policy, this would increase the price level. Suppose if it's unanticipated, then you know that this will lead to price level increase. That means the firm's real net worth increase, because the firm's price level lowers value of firm's liabilities in real terms, that is decreases the burden of the debt, and adverse selection declines, moral hazard decline, lending increase, investment increase, and aggregate demand also increases. And the final channel one, the remaining one is the household liquidity effects. So the household liquidity effects here clearly, if the rate of interest decrease, and what we already seen that this will lead to decrease in rate of interest leads to increase in stock price. That means value of household financial assets, the distress asset value of financial assets increases. It means when consumers have large amount of financial assets related to their debt because the increase in stock price, their estimate of the probability of financial distress is low, and they are willing to purchase more consumer durables or housings, etc. So as a result, you can see that increase in financial assets, financial distress decrease, they will be buying more consumer durables and consumer expenditure and aggregate demand. And actually these credit channels are very important. I have listed out few reasons why credit channels are important for monetary policy transmission. This is an overall, because the framework I have shown, this was mainly from Mishkin textbook, and other researchers also have shown different channels framework, but it's also almost same. You can see that these are the framework that they have used. And another channel, especially coming to Indian scenario, this is the monetary policy transmission channel that we can outline. This I have taken from Dua. So suppose the change in policy interest rate, suppose the repo rate decline, so you can see that the weighted average call rate declines. So this will have impact on the banking system, also on the other money markets. Then this will affect all these variables as well as these rates as well, then this will affect consumption, investment and net export, then affect aggregate demand, then finally this affects the final goals, the price stability and economic growth. So, in this session we had covered mainly the monetary policy transmission channels, and we had discussed what are the main channels and how it affects different sectors or different important variables of the economy, and finally how it finally affects the key economic variables. Thank you for watching this video. Thank you.